Hi, my name is Isma Sowakamo from FX Kampala. In this short video today, I want us to look at the 4 ways of how we can trade the markets. 1, we can trade the market through technical analysis. 2, we can trade through fundamental. 3, we can trade through sentimental. And 4, we can trade through mechanical trading. Well, for technical analysis involves having decisions based on the past data to determine the future of the market. Because now here we're looking at the future in various ways. It can be the next 1 second, minute, 1 hour, day, week, monthly, yearly, next year. So it doesn't matter, but the whole point should be knowing, looking at the history to determine what is going to happen next. And this makes it the sole reason as to why we all do trade. We all do trade to actually be in position to determine what, or to know what is literally going to happen in the future. So if we know what is going to happen in the future, we can now position ourselves and then profit out of the market. That is through buying and selling. So one of the ways that you can make a decision on whether you should buy or you should sell, it's through technical analysis. And this literally involves looking at the past data to determine the future. Just as the farmers do, they can literally be in position to forecast what is literally going to happen in the next seasons based upon what has literally been happening in the past seasons for years. So they are literally technical traders. They are looking at the history to determine what is going to happen in the future. So that's basically technical analysis. So we look at various technicalities, techniques, structures, and various ways of how we can really now study the past data to get something out of it, which is a trader's job now to do. So it's your job to define these techniques, the ways, the methods, the methodology that you should use to determine how you can study the past to predict the future. The next way of how we can trade the markets, have a decision on whether to buy, sell, or to leave without doing anything, is through fundamental analysis. Now with the fundamentals, we're looking at technically the socio-political and economic factors that do affect the markets. So by us knowing the social factor that can impact the market in either negatively or positively, in either rather a negative way or a positive way, so we can base onto that to either, if it's affecting the market in a positive way, to buy that particular instrument or currency that we are trading, and also sell in a case where it affects the market in the negative way. So basically, fundamental factors, I can give an example. Social factor, for a social factor, I can give an example as World Cup. Let's say, for instance, if there is any country that is hosting World Cup, which is a social factor, of course, this literally affects the hosting country in a positive way, which literally brings in demand of its currency, as due to so many people coming in this country, demand for the particular currency, and this brings us back to the law of demand, where we see that the higher the demand, the higher the price. So we see the price of this particular currency of the hosting economy increasing in value, hence buying it and positioning ourselves for a long, which is giving us a decision to buy because of this particular social factor, or to sell because of this particular social factor. Another one can be an economic factor. Economic factors are released in aspects of reports. They can be reports, they can be indices or figures that generally make a lot of info. all give us a lot of information, and are more important like figures to do with unemployment. So if the unemployment figure of a particular duration are released, so we may use them to determine whether the economy is doing well, knowing if it's doing well or badly with relation to what was released in the previous duration. We can use this to determine now on whether we should, position ourselves or buy the currency of, the victim, or selling it. So it's basically they are basically social, political, and economic factors that we may base on to decide whether we should buy or we should sell the market. Another way of how we can trade the markets is through sentimental analysis. This is something to do with emotions. At this point, we look at this probably if you see a couple of people buying a certain product, means that they have interest in it. The interest may be literally generally centered about their emotions. So if everyone is buying the market, so we can also buy the market, having a decision to buy because we've seen other people buying. So we're literally buying or selling, having a decision to buy or sell because of what other people are doing, due to their sentiments, due to their emotions. So we buy or sell, have a decision based upon other people's sentiment. So if the market is characterized of, if the market is bullish, and you can base on that to literally have an absolute decision to buy because the market is bullish for the sole reason as being that other people are also trading or bullish on that market. So we can have a decision based upon that by literally following what other guys are doing, which we may say it is something sentimental, something emotional. The last style, or the last ways or style of how we can buy or trade, buy or sell, have a decision, is through mechanical trading. Now, for mechanical trading, it's something routine, something that we usually something routine. This is something to do with asking yourself what usually happens when let's say when the London session opens, when the American session opens. There's always that certain way of behavior markets or traders do behave usually during certain occasions. Like you may say, according to this particular pair or this instrument, when the year is beginning, usually this is what happens. So if you really have proof by literally going to the back years and see on particularly this pair for the past 10 years, if this is what guys have been buying, most of the guys, let's say, can be buying for the past 10 years. So I can literally base on that info, something routine. This is something that people have been doing for this particular pair. They have been buying every beginning of a new year. So if that's the routine, then you can buy based not on any other factor, but basically on a routine, on what they have been doing, which we may say this being the mechanics of the market, the mechanics of the traders. So by mechanical traders, we're looking at general aspects that usually do happen in certain occasions, which I may call routines. So for instance, when you look at pairs like GBP USD, usually at every London opening, when the market is literally moving in one direction, let's say it's moving up, as it approximates to 11:30 a.m. in the morning Ugandan time, the market usually turns in the opposite direction as to the direction it was moving from 8:30 to 11:30. So from 8:30 to 11:30, if it has been bullish, that is 8:30 is the Asian session. If it has been moving bullish, then as it approximates, that's from 8:30 to 11:30. If it has been moving bullish, then from 11:30 it will now move the bearish direction. So we usually that's the routine. That's what usually something happens. So mechanical trading is basically something that newbies or people that are new into the trading business usually focus at and can profit out of it, and it's highly what I recommend for genuinely these people. So thank you for watching this video. Hope you really enjoy. Subscribe, like, and share. Thank you. I do sign out. Bye.